Hi everyone, it's Chap out with another video. Today I'm going to be talking about Intel, a company that I'm very interested in myself, gets a lot of coverage here on YouTube particularly, hugely important to the future of the US economy, major semiconductor manufacturer, the biggest in the US. USA is moving to guarantee its supply, as many countries are levering up to sort their own supply out in the wake of the current supply chain crisis and the semiconductor demand crisis. It's up only 32% over the last 5 years. It's actually down 23% in the past year, massively underperforming the market. Now sits at 29% off its yearly high of around $70, currently $48. It's now only a $196 billion company for such a well-known name and an important company. It's its lowest market cap for a while. I want to discuss it and see if I can figure out if it's undervalued, and crucially, is it a buy today? I follow Intel news very closely, and what inspired me to make this video was Forbes reporting that Intel is purchasing Tower Semiconductor for an all-cash deal of $5.4 billion. Tower Semiconductor, it's a decent premium, so it's up 40% today. Intel also, which is unusual for this type of acquisition, so clearly the market thinks this is a reasonable price. Tower Semi has very different markets to Intel, with 39% of its sales being radio frequency, mainly mobile and infrastructure chips, with some presence in automotive, medical and other industries. It has foundries in the US, Japan, Israel and Italy. Some nice diversification for Intel. Intel is clearly gearing up with 4 fabs in the US, so it's some nice diversification with some move internationally, and it's clearly showing that Intel's moving towards being an end-to-end third-party manufacturer in the same mould as Taiwan Semi. Also in January, which I haven't yet spoke about, Intel had announced news of an additional 2 fabs in Ohio with a $20 billion investment commitment. This in addition to the further $20 billion that they're working on in Arizona for another 2 fabs. That's 4 fabs in the US for a total of $40 billion. With this deal, that's just over $45 billion of investment, and I don't think it's slowing down here. This is a serious investment for the future, and from my point of view, this is exactly what Intel needs to be doing, and they shouldn't be slowing down. A nice point to add here is that this is an all-cash deal. This shows to me that Intel management values equity in the company highly and values it more than cash. It's confident in the deal. This is highly unusual for a company to use cash unless they're very confident in the deal, and more confident in the returns of the stock going forward than they are in cash. They think the equity in the company is more valuable than cash at the minute, and I couldn't agree more. Before I talk about anything else, I just want to dive into Intel's balance sheet, because really, if a company has a garbage balance sheet and poor profitability metrics, I don't want anything to do with it. That's not the case for Intel. The balance sheet is nowhere near perfect. Cash debt ratio of 0.75 is not great. It's a weak score for Intel's history, and it's particularly weak for the industry. But Intel is spending for the future, and with all cash deals like the one today, cash on the balance sheet will decrease. This is not of immediate concern to me. Intel has very good interest coverage, and the Altman score of 3.31 indicates this is a company that's safe from financial distress and is not at immediate risk of financial default. It's very cash generative business, Intel, so I'm not overly concerned about that. They're spending wisely, in my opinion. Debt to equity of 0.4 and debt to EBITDA of 1.12 again indicate that this debt is manageable as it stands, so I'm not overly concerned about this, although I will be watching this closely as they continue to spend cash on future investments. Looking at the profitability metrics, this is basically why Intel can afford to spend cash at a strong rate. Operating margin of 27.94, absolutely excellent. Very, very strong for the industry. Actually quite low for Intel's history, right? Not the lowest, but it's pretty low. But that is a strong number for any industry, and a particularly strong number for the semiconductor industry. Net margins of 25.14, again excellent. Not perfect for Intel's history, but really, really strong. That means they take home 25.14 cents per dollar after tax and everything else. Absolutely outstanding. Return on equity, again 23%, far above what I would expect for this industry. I'd be looking for 10 to 15% would be good. 23% is really strong. Again, actually quite depressed for Intel's history. Return on assets, 12.5. Not as strong as return on equity, but okay. Like, I would expect between 5 and 15% again. But perhaps actually that's maybe a bit ambitious, but maybe between 5 and 10. So 12.5 is good, not great. So overall, profitability metrics here are excellent. And that is kind of why I'm giving it a pass on the financial strength of the balance sheet, because it can turn around so quickly, because this is such a cash generative business. Next up, I want to look at some basic valuation metrics. The most important and obvious valuation indicator for me is the price-to-earnings ratio. PE of just 9.94 is far below the S&P 500 average of around 22, indicating that Intel's forward prospects are being discounted by the market relative to similar companies, and in truth that the market is just bearish on Intel. There's no denying this. Forward PE of 14.32 is still below the forward average of the S&P, and again indicates that the market is somewhat bearish on this company. And this also emphasises the spend that Intel will be outputting in the next few years, and that earnings will be depressed. And perhaps part of the reason why the market is so bearish on this and so bearish on Intel is because it will be less cash generative business. The buybacks will slow down. The dividend may be on the chopping block, which is 3% yield as it is, which is pretty strong above the S&P 500 average. So perhaps this is the reason why the market is bearish, but I think this is very short-sighted. Free cash flow is also reduced from previous years, indicated by a price to free cash flow of just 20. The price to earnings growth ratio of 0.72, where a cheap number is 1, indicates that price is a bargain relative to analyst growth earning expectations. And for me, this is a really bullish indicator on the company, and it's just about the best PEG ratio that Intel's had in its history or recent history. And again, price to operating cash flow 6.56, some of the strongest numbers in Intel's history and some of the strongest numbers in the industry. As you can see from looking at the graph, most things dark green here, or most things that matter dark green, indicating that Intel is very cheap versus the wider industry and very cheap versus its own history. Next, of course, is a discounted cash flow calculation. I want to do this to calculate an intrinsic value, a fair value that I'm willing to pay for the stock, and calculate a margin of safety. As you can see from this, I use the 10-year annual earnings per share growth rate. Free cash flow is a bit all over the place, down 52% year over year. So I'm not going to do a free cash flow calculation because it would just be unfair for us, unfair for everyone, and frankly inaccurate. So I'm using that 10.3% 10-year average growth rate of earnings per share. Earnings per share is actually down 1.6% over the year, but over the 5-year period up 21%. So I'm not going to ding it too much. I think 10.3% is about right. That's in line with the revenue growth over the previous 5 years of 10.3%. I think this is thoroughly achievable. I don't think it's too conservative. I think it's just about right. With even just 5% earnings growth, the price is $71 using a discount rate of 8% for the wider market. Intel has huge tailwinds behind it. If it can pull off the new fabs, I don't think 10.3% earnings per share growth rate is too unrealistic. And using this value, this gives, from a present day stock price of $48, this gives a fair value of $103.71, indicating more than 100% upside if it can achieve this 10.3% earnings per share growth rate over the next 10 years, which I don't think is ridiculous. That's a huge 53.46% margin of safety and a huge opportunity, frankly. And of course, if they can pull off the new fabs, if once the spending dies down, they bring back the share buybacks, they bring back the dividend, this could be a seriously cash generative company that is buying back shares, that is growing earnings per share, and perhaps more than 10.3% a year. I think this is conservative. I think the wider audience will think it is just about right. I'm optimistic on Intel's future and think perhaps it could grow earnings per share over the long term at perhaps 12%, 13%, and this would make it an absolutely fantastic investment at present day prices. Intel recently reported Q4 for 2021 and full year results. Neither of them were anything special. Q4 results up 4% year over year in revenue, gross margin down 4.6 points year over year to 55%, and earnings per share down 26%. Not particularly impressive at all. For the full year, revenue $74.7 billion, the highest in its history, up 2% year over year. Gross margin down slightly, but still 57.7%, which in my opinion is very strong. And earnings per share up 7% year over year, despite that huge loss in Q4 or the huge downturn in Q4. None of this is particularly impressive for me. They recorded record revenue in Q4 for the data center group on strong enterprise demand, which was up 22%. And client computing group was a drag on Q4 revenue, down 5% year over year due to modem ramp down. These are not particularly impressive and indicate the challenges that Intel has right now, but I believe with their impressive spending over the next few years, they can dramatically increase revenue and earnings per share over the longer term. Of course, they will be depressed in the near future. To make matters worse, the outlook for the company for Q1 2022 was not particularly impressive. Revenue of $18.3 billion, down 1% year over year. Gross margin of 52%, down 6.8 percentage points, which is particularly worrying. And earnings per share down 40% again, because they're going to be spending a lot. This is no surprise. But that revenue number, of course, there is some degree of seasonality, but that is not very impressive at all. I'm kind of giving Intel a pass here because I think it's going to take... I'm appreciating that they're executing at the minute. I'm on board with Pat Gelsinger's plans and I believe in him. I think it's going to take a while for the fabs to get online and be accretive to revenue, of course. Now is really the opportunity, in my opinion, to buy Intel stock while revenue and earnings per share are depressed before this company really manages to turn it around, if you believe in them doing so. One thing that I think could save Intel's earnings and cash balance a bit is the Mobileye spin-off. Mobileye is expected to bring a valuation of $50 billion in December 2021. Of course, the market has soured significantly on growth stocks, especially like full self-driving stocks with very little revenue, like Mobileye. They bought it for $15 billion in 2017, I think. However, this spin-off, in my opinion, would still generate serious dollars, perhaps 25 to 40 billion in that some sort of region. Of course, Intel has stated that they will maintain a majority stake. This seems sensible to me to generate cash in an environment where Intel is going to be spending a lot of it. Perhaps they sell, I don't know, 20% of the business, a 40 billion valuation. This would be reasonable in my opinion and could generate a lot of cash for Intel that they can use on future investment and to not perhaps protect the dividend a bit, or just in general protect the balance sheet, because I'm not so sold on them keeping a dividend. In my opinion, Intel is absolutely not a sure thing. It will struggle with earnings and cash flow in the near term. Pure valuation metrics will fluctuate. Perhaps the DCF will look inaccurate for a few quarters. The dividend's going to be on the chopping block. This is going to be a bumpy ride for shareholders. This is to be expected with a vast investment program. For me, Intel is valued like an old world, slow growth company, and that is probably about right for its recent performance. Intel management, however, are acting like those of a growth company. They're making aggressive moves, investing an enormous amount of cash, around $45 billion, or what's that, a quarter of the current market cap in 4 fabs in America. And the most recent acquisition, Intel is gearing up to capitalise on the major tailwinds the semiconductor industry has right now. If the Fabs Act or the Chips for America Act pass through Congress, which is absolutely no guarantee, but Intel is sure to receive assistance from the US government as the foremost US semiconductor manufacturer. Intel allowed a technology gap to build over the last 7 to 10 years and fell behind TSMC. They're currently working on 7 nanometer, whereas TSMC are working on 5 and 3. Management have acknowledged this, and their aggressive actions indicate to me that they are challenging this head on and in the right way. This could be a rare opportunity to buy essentially what is now a blue chip company, a $200 billion company with genuinely multi-bagger potential. Even just reasonable multiple expansion could see Intel return to its former highs of near $100. The total addressable market for this company is absolutely enormous, and it's not unrealistic that a business like this could be a $1 trillion company in the next 10 to 20 years with good execution. But that really is the key phrase there, with good execution. You really have to buy into management's future and buy into their vision, and I do buy into that vision. I think Intel is not a lost cause. I think this is actually a value stock at present. So I think realistically the next 6 months, a year, is this is going to be the lowest valuation Intel will reach. I think it's kind of now or never for these sort of prices. So I'm going to be buying over the next few months and dollar cost averaging. But of course, you should do your own research. You shouldn't necessarily take what I say as gospel. You should do your own research. This is not financial advice. If you want financial advice, you should contact a registered financial advisor, and of course do your own research. With that said, if you're enjoying the videos, please like and subscribe to help the channel grow. Thanks, and I'll see you again.